What's up, guys? It's Terry
and Rowan,
and we're here from Artismart TV bringing you another episode of the HSC Economics Review. Now, this is, I guess you could think of it as part 2 of a 2-video sequence. We're looking, if you missed our previous video, what we did was we did a very, very comprehensive deep dive of all the things that were leading into the reason why we went from a historically 40-plus year current account deficit into a current account surplus starting in 2019. Now, we talked about some things that led into it in 2019, but then we did talk a little bit about what was going on throughout COVID, but then we didn't really touch on some things that have been happening more recently. So that's going to be the focus of this video. What's got you excited, Ron?
Yes, I think what I'm really excited to dive into is looking at where it is with detailed deep dive stats, the current account, the financial account, the balance payments position, net foreign liabilities. Where are they today? Because I find that this is something that a lot of students struggle. There's some stuff in the textbook, but by the time the textbook comes out, it's a little bit out of date. And I get it. It's challenges with printing. That's what it's like. But I think students are then in this position where they're like, oh, but how do I get more up to date data on this stuff? And there's lots of it, but it's also really complex, right? Yeah. It's really hard to make sense of. So what we're hoping today, and that's what I really love this stuff, I'm hoping that what we can help you do is get up to date on where the stats are, right, for 2024, or at least the most recent data we have. A lot of that comes from the final sort of quarter of 2023. And also just help you make sense of it in terms of understanding it and knowing how to interpret it. Because there's a lot there, but it's also pretty overwhelming and confusing. Yeah, no, so I love that. So what's got me excited, though, is that there's actually going to potentially be a shift in the narrative once again. So a lot of twists and turns when it comes to Australia's balance of payments. How exciting. And I think it's going to be challenging if you're doing HSC Economics in 2024 or 2025, right? Yeah. Simply because I think, when you've had something that's always been, let's say you've had multiple years of a current account surplus or multiple years of a deficit, that's all you sort of talk about, right? Yeah. Whereas if you've got a shift occurring or in a period of time, 2 very different outcomes, I think it's awesome because it makes for a much more interesting essay and response, right? But it also makes it more complex. Way more complex. And I think the other thing is that as if you've probably seen one of our HSC predictions before, typically if there is something exciting going on during that year, it also increases the likelihood that it's going to pop up in your final HSC exam. So definitely would pay attention to this one. That's right. So a little bit of quick context, right? So historically, as Terry said, we've been in a deficit averaging minus 2.91% of GDP. Now, since late 2019, we've been in a current account surplus. We reached an all-time high of 4% in surplus of GDP in the third quarter of 2021. Now, in saying that, 2023, Australia's current account came back to 0% of GDP. So, as Terry's highlighted, we're seeing this pendulum potentially shift. And right now, we're almost at neutral, right? We're in the middle here. Is it going to swing back to, just a temporary sort of neutral position and be at a surplus again? Or we're going to move back into a deficit? Yeah. And I think that's what we can look at. But certainly, I think we've got some other stats we should unpack. Yeah, so we get there. Yeah, even before that, I think one thing that I just remembered was that when we did initially get that surplus in 2019, there was a lot of conversation about that being a very short-lived surplus. Yeah. That there was expectation that it was going to flip back in 2020. Obviously, 2020, as you guys hopefully remember, was a very, very interesting year, and then we were able to milk out a couple of extra years of that surplus. So I know there's probably some people who are out here with Team CAD, Team CAS, I don't know what team you guys are on, but it's probably not going to be as clear cut. And again, that's just kind of why it's so interesting for us to look at this data. That's right. And I think that's a really important point because you're right, it was expected to be short term. COVID hit and that created, a whole lot of outcomes globally, economically, that no one really expected. And one of them for us was the benefit that we saw that current account surplus continue. And that's going to have and we're going to look at it when we look at the impact on net foreign liabilities today. Because it's actually had some really great impacts for the Australian economy, and certainly for our external stability position, which is, again, one of those areas that the balance of payments sort of integrates a lot with, and I know students struggle to sometimes weave together. So let's look at some stats to sort of kick things off. And this is all from the September quarter, which is the most recent data that the Australian Bureau of Statistics has published. Now, I think the important thing to highlight here is that our current account balance fell and became a deficit of 158 million. Now, you could give me 158 million, I'd be a very happy man. Yes. But in the context of a whole country, Rowan, is 158 million
much to say.
No,
'Cause we've already
it's-
touched on it earlier.
yeah.
It was basically 0%.
That's right.
Yeah.
It is absolutely exactly right. Like it's 0%. It's not saying it's like -1 or -2. It's 0. They're basically calling that neutral flat, even though it's 158 million.
It's a rounding error.
Yeah, that's exactly right. Now,
Yeah.
note, I think the thing to highlight is that the surplus in the quarter before, so we did have a surplus in the quarter before, and that was 7.9 billion, or 7.8 billion, I should say. So it's had about a 7.9 billion turnaround from positive to get to that negative, that small negative figure. So there's been a relatively sharp change in a relatively short period of time. Now, alongside that, the net primary income, of course, stayed relatively flat, right? That hasn't really, and that's because it's a structural component, right? That hasn't been the driver. So what we've really been looking at here is we've really been looking at a change in the trade balance, right? And as a result as well, some changes in our financial account. So we should pause to look at that because, again, I think this is like the perfect time for us to be looking at the data because of the shift that we've just seen. So what's been some of the reasons that have caused this recent, 0% as a percentage of GDP? What do you reckon, Terry?
So, as Rowan was already touching on earlier right there, so it wasn't really the net primary income to blame. So if we're going to look somewhere, we're going to have to look at the trade balance and the balance of goods and services. And obviously a very big supporter of that original surplus that we had in the box was the fact that we had very strong exporting numbers. And reflective of that was very impressive terms of trade, a very competitive Australian dollar, and just overall high levels of global demand for Australian exports.
And great commodity prices at the end of the day, right? I mean, they've come down certainly from their highs, but over the long term, we saw rather
they were still decent. Like
That's
I
right.
remember, I think in the previous video I mentioned that iron ore prices had spiked to about $250 per ton in 2019, 2020. But even into 2022, 2023, they were still a fairly respectable, $100 per ton.
Yeah.
And so they were still quite strong. Hasn't really kept up because if we look at the export prices, what they've done is they've actually had a 3.1% decrease just in the September quarter alone.
Yeah, so I think it should be highlighted. That's the total goods exports, right? Volumes were down by 1.2%, prices were down by 1.9%. So you're sort of seeing that for goods exports, right, and I think the thing to highlight here is, and this is important because I think when we share, and we're going to share a bunch of other numbers like this, none of these numbers are huge, right? Like we're talking about 1%, right? But when we see exactly the types of percentage movements, right, in both exports and imports, small changes have changed a $7.8 billion surplus to a $158 million, and so small changes have significant impact is the point. So, service exports, right, we actually exported more of them, 1.9%, and, prices were also up a little, but you can see that, like, overall, right, like our goods exports, they were down, and that was playing a bit of a bigger role in driving the outcome. Right?
In our previous video, in case we kind of briefly touched on this, is that the goods export are a much larger component of our export
because it's commodities, right? It's like almost 70% we talked about as a high. It's sitting well over 60% right now. So again, it's like great services went up, and services went up for good reasons, right? They went up because we were having, travel again was opening up, particularly education in terms of, a lot of foreign students being able to return to Australia. So there were like good reasons for those service exports to grow. But the bulk of our exports were coming in goods exports, and we saw the volume down and we saw the price down, right? Not ideal. Yeah. Now, alongside that, and this is again talking about like margins, right? Service imports, they went up by 8.4%.
Yeah, there was a time last year where I'd hop on Instagram and I just felt like everybody was overseas at that moment. I wonder if that had an impact there, Rowan.
Yeah, I know. I'm wondering as well. And so, exactly right. So, while we've seen exports, small changes, but roughly probably trend a little bit down, right? The flip side is that we've also seen imports grow. And the irony is, like, with imports, the bulk of our imports are service imports, where the bulk of our exports are goods exports, right? So this also disproportionately has more of an impact on our import overall outcome. And so, outcome is, we start to see small shifts in that export and import volumes and prices start to play out in big shifts in the balance, right?
And I think there's one number that even jumps out to me. I mean, obviously you're right. Small shifts are starting to kind of compound on each other and starting to make a bigger difference. But even within a small component of that, if I'm looking at imports, service imports, I mentioned travel, and I wasn't joking about that. Everyone was literally going overseas, but I'm now seeing this now that travel actually increased by close to 20% in terms of volume, right? So the stats kind of also support the story that we're trying to tell you guys here, and look, that's no fault of anybody. So. I don't know, if there's a theme of this video so far, it's been that the takeaway is that all of you who went overseas last year, right, and went on a nice, beautiful holiday, you're the reason we're going to be back
in a current account deficit. Yeah, that's right. Now, look, of course, transport costs were also part of it. Like if we're importing in, that sort of links in a little bit to travel as well, right? That also was like, an increase of volume of 10%, right? So there's some areas that have done that. Now, what's interesting is just looking at the sort of terms of trade, right? And so the terms of trade, didn't shift significantly. It went down by 2.6%. So it went from 95 in June quarter to 92.5. But I think what we're certainly seeing is it really come down from the high that we, September 2022, so a year before, right? We were sitting, around 110, right? And so we're seeing this slow downward trend. And again, whether or not this downward trend continues, I think, is also going to play into whether or not this is just a one-off quarter where we're at, 0%, or if it continues, right, the likely outcome is, we start to see us move back into a negative trade balance.
Yeah, so I want to kind of, if I'm looking at this data as well, I'm seeing it as if the terms of trade did tend to overperform a little bit during that kind of COVID period. And so, as Rowan highlighted, yes, it is starting to kind of trend back downwards, but I'm looking at that and going, that might be quite sustainable. That might be something that continues to happen, just because, as I said, if we were overperforming for a certain period, we're just kind of returning to our expected performance.
And I think that's important to highlight, because if we look at, and this links into the prior video that we've released. So if you haven't watched it, recommend go and watch it. We'll leave a link below, which is about why we have a current account surplus. One of the things we talked about in that video was the fact that our terms of trade from about 2016 started improving. Yeah. And, you can see that, it starts sort of really, sort of sitting, really in the mid-60s at the end of 2016. So, not particularly great, right? And you see an upwards movement. And let's go to pre-COVID, right? Because obviously COVID starts changing things. But, by, 20, like the start of 2020, right? Before COVID hits, it's now sitting at about 80. So you've seen almost, right, like a 20-point improvement in the terms of trade. So it is trending upwards. Now, of course, COVID hits, it jumps, from the 80 to 110, it's just short of 110, right? And now it's trending down. But you're right, it may end up landing and sitting somewhere back at the 80, right? Which is still going to be good, but whether or not, with all of the other factors at play, it's going to be good enough to retain a positive trade balance, that remains to be seen. Now, let's go look very briefly as well at what's happening on the capital financial account. And really, we're talking more specifically about the financial account, right? Because again, there's a relationship here. It'll never equal perfectly, but if we think about it as a scale, right? As the current account, let's say, goes into a greater deficit, well, there's going to be correspondingly shifts that should occur in the financial account. So what's some of the things that have been happening here?
Yeah, so I think I want to highlight again what you're saying in the other video, although it's not a perfect relationship, that when the current account tends to move in a deficit direction, the capital and financial account will move in that surplus direction. That's exactly what's kind of played out here. So the numbers we have here is that it got to the financial account got to a surplus of 3.4 billion in the September 2023 quarter.
And just to highlight, in the June quarter prior to that, it was a deficit of almost 17 billion.
Oh, so that's like a 20...
Yeah, so it's literally, $20.2 billion turnaround in the period of a quarter, right? Now, what was that driven by? Well, again, we can sort of take a look to see where are the big changes, and we're looking at the financial account specifically. And with direct investment, pretty much no change, right? 265 million. Again, that sounds like a lot in the grand scheme of 20 billion. It's nothing, right? The majority of that change happens in portfolio investment, right? So we saw almost a $15 billion change in portfolio investment occur, right? And so as a quick reminder, what's portfolio investment? Why might that be quicker to change as well?
Portfolio investment is the rule that they use is I believe it's 10% or less of ownership of shares or a company. So the main thing is that you're investing for the purpose of putting it into a portfolio. You're not investing for the purposes of actually taking control of this company. And the reason why that's important and why it's easier, as you said, is because it doesn't require anywhere close to as much capital to actually make that investment. It literally could be somebody just saying, hey, I want to go invest in some Australian stocks. I'm a regular dude. I'm going to go buy some Australian stocks. Let's go for it.
Yeah.
Yeah.
And so what's interesting then is and look, I don't know if I have a good answer to this. So I'm hoping you do, Terry.
Okay. We'll see.
Part of me wonders, like, well, okay, what was driving such a change in that quarter, right? Because basically the crux of it is for that to occur, you've got like either one of two things occurring, right? To create a net effect, right? Where you've either got like a lot more foreigners investing in Australia, right? Or you've got a lot less like Australians investing overseas, right? And they're pulling funds like out, right? I think I've got that right.
Pulling funds out. Yes.
Yeah. Okay, cool.
Yeah.
Right? Yeah. It's confusing, guys.
Yeah.
I think this is the point, right?
Yeah.
And, look, we're looking literally at, like, a table that's got, like, the financial account, direct, like, assets. Like, it's an intense table that we're trying to make sense of here for you. So the point, though, is, like, it's, what's driving that, right? What is causing, in most cases, probably more portfolio investment into Australia, right? Because what we've seen is an increase of, net capital importation occurring in this quarter. Why, right? I mean, do you have any insights on maybe why that's the case?
I don't really. Look, I can only speak quite broadly in terms of what's happened around the world. I know that the US stock market's had a really, really good run. So I don't see why there'd be a reason to pull out from that.
Yeah.
Yeah.
Yeah, and so exactly. Like, that's why I don't really have a good answer either.
I don't know if anyone does. The thing is, Roland, I think we're probably getting a little ahead of ourselves. I don't know if anybody really does. Because as you said, because the thing is with portfolio investment, it can be quite, like the money can be quite hot.
Yeah.
It can move very quickly and for reasons that aren't immediately clear until some time has passed.
Yeah, that's true.
Yeah.
So I think that will be interesting. We may get more clarity on why, but that's really been, I think, the major shift, right? And I think the reason it's important to highlight this is because I think often, you'll get questions sometimes. It could be a short answer. It could be, relating to like, portfolio, what's direct, what are the trends in portfolio? They don't really come up all that often. But I think... you can sort of see that broadly, right? Like things do change, right? And they can change relatively quickly, as we're seeing here. And that can play a role, definitely. And we can see that in terms of what's happening across these two accounts. Now, I think let's zoom out again, because I think we went pretty nitty-gritty to just give it, some data around what's going on in the current situation and why, even though we don't have a full good answer about the change in portfolio, and let us know if you do in the comments. We would really love to know if you've got, some secret sort of insight. What's been the effect of all of this, not just in this current year, right? Because obviously this is over the last couple, but on net foreign liabilities. Because that's another area I feel like students struggle to get up-to-date stats on. And understand it well.
Yeah. So the first thing I want to highlight about is what is the net foreign liabilities. The way I like to think of it is it's almost like a summation of everything that's been going on in the capital and financial account. But rather than the capital and financial account only measuring the performance over a 3-month period, the net foreign liabilities is like overall, where are we?
Yeah, over many years.
Yeah, many years. So you can take a point in time and then go, well, that's where we're at that time, and it's really, really interesting. Like I couldn't. Me personally, I was surprised by how much this changed.
Oh, same.
Yeah.
I was quite surprised.
Yeah, because I just remember when I was, first starting out my career and also when I was doing this course myself, it was pretty much a consistent theme that the net foreign liabilities would always hover around 50 to 60% of GDP,
right.
which is a lot, which means we have a lot of financial obligation to foreign countries, right? More than half of our GDP. What's happened now is it's actually currently sitting at 31.5%, down from a peak of 62% of GDP, which is
crazy, isn't it?
It's essentially halved.
Yeah, and if we look at it as well, right, like that has halved, like since 2019. It's, really over a 4-year period.
That's crazy.
Which, is just absolutely nuts. Now, the reason this is also, I think, interesting is because this is where, this sort of interplays with external stability. Right, in terms of as an economic issue, like usually, NFL as a percentage of GDP, right, is usually like one of the measures that you might look at to look at how, externally stable a country is from shocks, right, that might happen in the global economy. And so this is a really good thing. Like looking at this, it's like, well, great, actually, like relatively, this is significantly improved. Now, I think a lot of this has been because of our shift. And again, if you want to know more about why, go and watch our video about why we have a current account surplus. But because we've become a net capital importer, right? Because we've been importing capital, from overseas over the last couple of years, it's really contributed to that decline in our net foreign liabilities. Because we became a net capital exporter.
Yeah.
Sorry.
No, in our previous video, we did the same thing.
Yeah.
Same thing.
Yeah, so we used to be a net capital importer, hence really big, 60%. Yeah. We shifted to a net capital exporter, i.e. we invested more overseas, and that changed our liability position. Yes, thank you for catching that.
And it does feel weird to say that, doesn't it?
Yeah, it does.
Because last time I said it.
Yeah. Now, I think it's important to highlight a couple of things here as well, because this is also because one of the other factors in all of this, if you go to the external stability, and I'm bringing it in because, and the Australian dollar, because they're all so interconnected at the end of the day, right, is... Okay, what role does the dollar play in all of this, particularly when we look at our net foreign liabilities and our external position, right? So, Terry, do you want to kick us off? Like, when we think about the dollar and we think about what's been happening with our NFL, what is the dollar doing here and how is it helping us?
Yeah, so just like with the way I draw the parallel is just as with trade as well. So the dollar has a very big role in terms of affecting the level of attractiveness. So the same way that it could make exports look more attractive, it could also make investments look more attractive by having a relatively weaker dollar. And so there's obviously been a lot of noise that's been going on with currencies around the world. A lot's been happening with COVID and whatnot. Now, what I've always find very interesting about this is that, we talk about how important the dollar is, but then there's almost like a footnote right at the bottom of it just goes, well, actually the dollar doesn't matter in terms of because of the way that the currency is
that's right.
denominated. So it's interesting. You learn about it in theory, and then you just go, never mind, scrap all that theory.
But maybe let's explain why the dollar sort of does and doesn't matter, right? So let's just quickly start with net foreign liabilities is where we look at what Australians have invested overseas or we have lent, and it's offset, right, by what foreigners have lent to Australia or invested in Australia, right? Now, the reason I just want to share that is because it then depends on what currency those investments and loans are denominated in. So, for example, most Australians, when we borrow funds in international markets, we convert that into Australian dollars. Okay, now we do so through derivatives. You've probably heard about that, particularly because it's one of the items in the financial account, right? And that's known as hedging, okay? And that's basically where what they're trying to do is, because if you've borrowed money in another currency and the Australian dollar goes down, that loan has now grown in value.
Mm-hmm.
So,
in theory,
right? Yeah. So if you have basically converted it essentially to Australian dollars through using derivatives, now the change in the currency of the Australian dollar doesn't impact the size of your loan, right? And that's a good thing for you, right? Mm-hmm. So in other words, Australians have done that, through a lot of the money that we have borrowed. Now, on the flip side, though, what's interesting is that over half of Australian foreign assets that we have basically purchased or lent, that's still denominated in foreign currency. So in other words, half of that, we've done the same thing. We've gone, we'll convert it into Australian, so that, or we've lent it in Australian, and then they've converted it to their currency. But half of it is denominated in foreign currency. And that's good because if our currency then drops, well then great, the value of that asset has just increased, right?
And then the return that you earn off of that
is also
going to be higher.
Which is why we tend to do it a lot less when we invest overseas, right? Because there's a net benefit for us. Now, the point of all of this, okay, just to try to bring it back, is that basically what this means is Australia has what's called a net foreign currency asset position. I know that's confusing, but essentially what it means is that Australian residents own more assets denominated in foreign currencies than we owe liabilities denominated in foreign currencies. So what does this mean as a net effect, Terry?
Yeah, so I think it's really important we get to that. I think the main thing is that, as I said earlier when we first got to this segment, it was that there's what happens in theory and then there's what happens in real life. So, Rowan, I'm so glad you did it because I hate doing that every year when I have to do it. But as a result of that, what that means is when the Australian dollar depreciates, which theoretically means our our MPY outflow should actually be increasing, it actually has the opposite effect, which is really, really advantageous. It's really, really smart of us in terms of the way that we decide to set up our foreign liabilities. Because what that means is when it depreciates, as Ron said, remember he said that the payments we make to foreign lenders and investors, they don't change because they're only paid out in Australian dollars. And I want you to stop and think about that for a sec, because if something's denominated in Australian dollars, it doesn't matter what the exchange rate is because it's only going to be paid in Australian dollars. Now, on the other hand, though, at the same time that foreigners are investing and lending to us, Australians are also investing and lending to foreigners. Now, what Rowan said was that half of those are still denominated in the foreign currencies. If the Australian dollar was to depreciate, any of that income that Australians are making overseas, when that comes back, it will now buy more Australian dollars because the Australian dollar is weaker. Now, please feel free to slow this down, repeat this one. Yeah. I want to also just give a little bit of an analogy again. I'm sorry, I'm just on my analogies today. I would liken this to what Australia is essentially doing here is they're being that friend where, like, maybe that you give your friend you give them notes and you share your tips and stuff with them, but Australia is that friend that just gatekeeps. Now, I don't know, Ron, you know what the word gatekeeps means.
I do.
I know the audience definitely knows what gatekeeping is, but so essentially we're being a bit of a gatekeeper. Now, one more thing I just want to highlight is that this sounds really good for Australia. It sounds like there's no cost to us, but there is. So Ron mentioned earlier that you what you're doing is you're setting up a hedge, and that requires you to purchase a derivative. Yeah. Now, that doesn't come free. So the companies that do the borrowing, they actually do need to pay for that. And there's probably sometimes, depending, I don't want to go too far into it, but depending on how it's set up, there might be an ongoing fee, could be a one-off fee. I'm not too sure on that. But the point we're just saying here is that it's not for free, because if that was the case, everyone would do it. Yeah. But the point is that what that is essentially doing is it's kind of taking away some of the heat of what a depreciation would normally do to our balance payments.
That's right. Because if 50% of the foreign assets are in Australian dollar, it means that 50%, whenever our dollar goes down, 50% of them grow in value. Yeah. Both in the asset value, but also in the payments we get. And so, precisely right, it further is one of these reasons why a low dollar is actually a really good thing in many respects for Australia, because it improves our international competitiveness, our terms of trade improve, so the trade balance generally starts to look a little better because we import less as well, because imports are expensive. I mean, imports are less price sensitive because we need to import a lot, but generally speaking, there's a little bit of lower demand for imports. Our exports grow, so our trade balance usually shifts to be a little more positive. And then what we're seeing here is that it also has positive impact for our net primary income, right? Because of the hedging that's occurred, less the costs for derivatives. So
the only negative I can then think of, though, is that it does also actually open investment into Australia becoming more attractive again. So
that's right. Yeah.
So it's not like, I think that's the thing, though. Like, you're never going to have perfectly go one way. It's just about offsetting.
Yeah, that's right. So as we go to wrap up, I think what we should consider now is the question of, are we moving back towards a current account deficit? We've seen that current account as a percent of GDP is 0% at the moment, and it's clearly swung from a surplus. The question is, will it continue to swing towards a deficit? What are some things we can look at, Terry, that might give us some insight about what 2024 will bring?
So I think a big part of what we've been looking at throughout this video and the previous one is just whether or not Australia is in a position to be a net importer or a net exporter of capital. I think it's increasingly likely that we are probably going to be a net importer of capital. But one thing I kind of want to highlight, though, is that it's a different situation in that when we just looked at the fact that our net foreign liabilities are literally half what they used to be, I start to look at it and go, yeah, maybe the situation is going to be similar, but the environment that we're doing it is different now. So yes, we're going to be importing capital, but we're now importing capital at 31% of GDP net foreign liabilities, as opposed to 50-something%. And I'm wondering, because we now, even if we are importing capital, we're still, as a result, though, we're going to have, it's not going to be as large.
Yeah, it's a smaller. Yeah. So we'll see smaller as well current accounts as a percentage of GDP, right? Because obviously they reach a point in the late 2010, like 2007, 8, where they were getting like over 7%, like close to 7%, right?
Yeah. So I think fundamentally, we might shift into a deficit for a little bit, but I wouldn't be surprised if we shift back out.
Yeah. And I think there's clearly the key is going to be some volatility. I think there's going to be shifts, and I think some things we can look at. certainly is if we look at like savings, right? We're seeing certainly household saving levels fall again post-COVID, as a result of just inflation, right? Like costs rising. So the savings of households are falling equally for businesses. And so if we look at that as a trend, we're sort of seeing, okay, that saving levels fall, but, remember superannuation is really like structural savings, really, because we have to do it, it's built in, and that's growing, right? So that, I think, goes to the point where that may start, that increase in that super rate may sort of see that savings rate national savings stay as a pool larger than it has been for some time. But on the flip side, right, if we look at the bogs, service and good imports are again increasing, right? And increasing at a rapid growth. Exports are, they're not decreasing by any means, like 1%, like very small. So I'd say they're remaining flat. And that goes to, I think, your point, Terry, about, well, okay, maybe we sort of see this like, we're sort of dancing, right, around either side, depending just on some of those cyclical factors and how they play out. But I think, it's going to, as I think we highlighted at the start of it, I think it's going to make for an interesting sort of 2024, 2025, and certainly for you as an economics student, right, needing to write about this, in, essays and maybe some of the 5 mark short answers.
Yeah, so one last thing I just want to add, I think 100%, I think it's going to be dealing with a significant amount of volatility. But I think if we look at the structural factors that are now in place, you mentioned superannuation, you mentioned a couple other things. I think at the end of the day, even if it does tend to shift between a surplus and deficit, I don't think we're going to see the extremes that we once did. Because I just think that it's a different economy that we have set up now, and there's just so many like mitigating factors at play now that even if we do slip into a deficit, I don't think it'll be a very large deficit.
And I think what's great about all of this is, if we were looking at external stability for a moment, the position is really quite positive.
Yeah.
If we sort of look forward, right? Looking at the NFL, looking at the fact that we may be looking at overall like smaller deficits if we do get them in the current account. I think all of this really bodes, I think, really positively for Australia's ongoing ability to withstand changes in the global economy, which I think is really fantastic. So look, if you have any questions, let us know in the comments below. As always, we hope this has helped. If you need any more support, like this has been good, but some of that stuff around, like hedging and like net currency asset positions and all that sort of stuff is doing your head in. Don't be shy, get in touch with the team at Smart. We've got a fantastic team of tutors and mentors that can support you navigate and ace the HSC Economics course. We'll leave a link below. Otherwise, we've got more videos coming for 2024, so hit subscribe and we'll see you in the next video.